What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 24th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I want to spend some time to try to give a comprehensive understanding as to why, at the moment, I feel we have much more downside to go in price. I want to talk not only about some of the things we've already iterated here on the channel, but also share a couple of different perspectives that can start to give us a clear picture about why the supply and demand for Bitcoin's price will not only not allow it to go up or remain neutral, but more likely than not, start to churn lower. We've got a lot of things to dive into. If you guys happen to enjoy the video, give it a like, and let's go ahead and continue on with the conversation here. So I want to go ahead and just first start off with something we haven't done over the past few weeks. And that's just to simply take a look at the long-term chart. If you guys know, if you've been following me here on the channel, I like to zoom out. I like to look at the long-term time frames. And boy, will the Bitcoin chart tell us a lot about what's going on, especially after last week's sell-off. If we just simply take a look here at the long-term chart, we can start to see a big difference or divergence from the usual trend we see when we come down into one of our time-tested indicators here, both in crypto markets and in equities. And that is the 200-week moving average as well as the 200-week EMA, the exponential moving average. Now, usually we see that these two indicators are usually buy-side dip indicators during bear markets. When price gets down into this range, we usually see buyers coming in swiftly, bringing prices back up and servicing as a great buy the dip opportunity. Same happened here back between November 2018 to March and April 2019 before the big pop going all the way to 14K. And here during the March 2020 correction, back when the world was absolutely fearful. Well, if we take a look at what we're doing right now here within the summer months of 2022, since the final flash sale in June of 2022, since then, we not only went below these moving averages, but remained below them. And after getting a slight opportunity to get above just the 200-week moving average, not even tapping the 200 EMA, which I think a lot of bulls or short-term bulls had expected, we saw an 11.5% dip here in price, traveling right again back down below that moving average. Now, if we just zoom out here, we can not only start to see this manifesting here below the moving averages, but if we just simply take a look at the monthly chart, something definitely looks a bit off here. The momentum in Bitcoin has really started to stall here after a clear double top back from the previous bull market. And I think this speaks to a very important point that some people have brought up before, and that is that Bitcoin, albeit it has lived through short-term bear markets and equities, or kind of the typical recessionary degree of corrections in equity markets of around 20 to 30%, we have not seen Bitcoin live through a depression or wider scale recession. And that is where we usually see equities correcting 50% or more in valuation. We just haven't seen that for Bitcoin. It's not Bitcoin's fault, it just hasn't traded during one of those periods of time, as Bitcoin has only really had exchanges where it's liquid and tradable since back here on August 10th. So it is important to understand that here, that Bitcoin has not gone through one of these dramatic corrections. So understanding that, and understanding that the typical corrections in the past have been 75 to 80%, we should be open to the idea that at a minimum, we are likely going to revisit that type of correction range. And if we take a look at the long-term chart here, we can see that that is simply not something we've seen just yet. Again, if we simply clear the drawings here, take a look at the percentage decline, we find that from top to bottom here, we've only gone down around 74%. That is very telling here, and that likely means that we've got room for at least one more leg down. I'm not calling for $5,000 Bitcoin, nor am I even calling for a $10,000 Bitcoin. Just something that would take us lower than the previous lows we saw back in June and would signal another key sign of capitulation. We're going to talk about that as we go later on to some of the important data science models and macro events that we need to be cautious of. Now, first up, you've already got the concern here around equity markets, and a lot of the other charts we'll run through real quick. After an 18.8% relief rally here in the S&P 500, we've had so far 2 weeks of downward moves here, yet again tapping on top of that line of resistance, hitting the 200-day moving average and starting to utilize it as resistance. And on top of that, if it were bad enough that equities were starting to correct, which we know if equities are usually going up, crypto will likely move up to some degree. It's actually been quite weak against the recovery in equities. we are likely going to see if equities pull over that crypto is going to get hit just as hard. That's at least been the case for the past year, and until that trend starts to break, where that correlation stops continuing, then we have to continue to expect here that things are going to move lower. On top of that, you've got the inflationary indicators here, the prices of oil and natural gas continuing to tick up here. From back in mid-August here, August 17th, we can see that we ranged around $85 at the lows and now ticked up back to the highest range here since the early part of the month here, around $94. If we get a close above $95 here, or if we start to see on natural gas that this resistance doesn't continue playing out and we get a breakout up to $10, these are going to be all the signs you need to know here that the Federal Reserve cannot cut interest rates or slow down the growth rate of interest rates, that it is going to have to go even harder than it has over the past few months in order to try to cool down consumer demand in the economy and bring back equilibrium. Now, outside of that as well, all the indicators that are signaling what the Fed is going to do going into the month of September during the FOMC meeting are signaling risk off. We are seeing the dollar continuing to charter towards its highest level we've seen in nearly, I think, about 10, 20, 30 years for the dollar. A massive, massive increase in the dollar's value here, something that we haven't seen as far back here, as far back here as 2002. So 20 years, the highest level we've seen, the dollar. And on top of that, taking a look at the US 30-year yield here, what's going on? On the weekly chart, we can see that we're continuing to build up here. Week by week, the bond market, which is hyper effective at guessing what the Fed is going to do based off their words and their actions, and the macro factors in the economy, are signaling at its highest level here since back in late June that the Fed is likely going to continue rising rates. And that's why bond yields here are continuing to charter higher here. As the federal funds rate goes higher, bond yields should go higher, generally speaking. But I know a lot of people might be looking at this chart here, taking a look at the dollar index and thinking, hey, Nick, the dollar index looks a bit overextended. Not to mention here, taking a look at the US 30-year yield, could this be a head and shoulders pattern? Well, perhaps it could be. Over the next couple days and weeks, we are going to have to see what the market starts to price in. And if you want to wait on those confirmations before getting bearish, I don't have any problem with that, and I can respect it. But to be honest with you all, there are a lot of key signs here outside of just these two charts that are starting to signal a worry. For example, we can see mortgage rates, even though they have started to come down a little bit here over the past few months since back in late June, we can see the mortgage rates are still elevated 93.6% from the absolute lows, still at their highest range here, ranges we haven't seen for mortgage rates since as far back as April of 2010. And on top of that, mortgage-backed securities, so we can see here through the Vanguard Mortgage-Backed Securities ETF, one of the more popular vehicles for investing in mortgage-backed securities, we can see that they're still continuing to decline here since back in August. This was yet again another leading indicator for why equities were starting to, were in a position that they were likely overbought, right? The reason why is because if mortgage-backed securities are starting to decline, this is likely an anticipation that the Federal Reserve is going to continue to be a net seller, not remain a neutral holder or buy more mortgage-backed securities. When we start to see this trending higher here, that's another way where the smart money is starting to showcase that the Federal Reserve is going to engage yet again in balance sheet increases through quantitative easing. Again, we are not seeing that here. We are basically where we were back here in April of 2022, and looks like we are going to continue to either chart it lower. But the one thing I wanted to draw here, again, back to that point about the potential head and shoulders on the US 30-year yield, is that for the bulls, we better hope that we're going to see this be an inverse head and shoulders here. Essentially speaking, that if we start to see price come down to this range here, similar to the lows back here in May, around 47.6, and we start to see a bounce up higher here, that would be your signal to start getting bullish, to start taking on risk, that the Federal Reserve is likely going to stimulate financial markets once again. But for now, we are betting that we are likely going to see this continue going lower here. Yet again, rolling over here down not only to the previous lows, potentially even lower levels here as well. Again, there really doesn't seem to be any range of support in sight here. Mortgage-backed securities have started to trade at their lowest levels that we've had on recorded history as we've come down into this pocket here in 2022. And seeing as mortgage-backed securities are generally seen as a junk asset. They are filled with lots of mortgages that likely aren't going to be repaid, hence why the Federal Reserve bought them in the first place. The whole purpose of quantitative easing was to remove essentially these toxic assets from the balance sheets of insurance companies or banks, all types of commercial and enterprise investors. This is, and again, something that is likely going to weigh down the market as the Federal Reserve is trying to liquidate these assets on the market, removing cash from the system as they're taking the best available price that they can get. It's a game of hot potatoes. No one really wants these things. Now, the key thing here that I wanted to bring up that I think is, again, another sign that the bears are going to be in the lead here, unless the Federal Reserve does something cheeky, comes out early on and starts to maybe provide some signs of relief. What we've seen here is that the FOMC meeting is not going to be happening until September 20th to 21st of this coming month. So we are not going to be getting any potential signs of pivoting unless something happens outside of the FOMC meeting, which usually doesn't happen here. We already had the meeting minutes here, which have started to spook financial markets. That's why we saw this rejection here. A lot of people were hoping, a lot of the bulls were hoping that the Fed would come out with some comments on pivoting to benefit financial assets, and we did not get that. We had 2 solid red days and no solid buy-side pressure coming through to follow through. And we are holding by a thread here, trying to see if we can make this range support. And while I wouldn't bet against a potential short-term small bump here, maybe a day or two of green price action, I really think this further solidifies the price action we've already seen solidifies that we're likely going to roll back over. Now, it would be one thing here to just talk about the macro perspective, right? We talked a lot about that here on the channel. It's where we excel, as I've been trading in equities for the last 10 years, and it's how I like to view financial markets. But one of the key things that a lot of people haven't been talking about that needs to be known by you guys who are investing in Bitcoin, who are investing in Ethereum, it has to do with Mt. Gox, or Magic the Gathering online exchange, the first major Bitcoin exchange back in the day that had gotten hacked, and the recompensation plan that is likely going into effect as we move into August and September of this year. Now, we don't have the exact dates of how this is all going to play out, but one thing I wanted to go ahead and talk about is the noticeable difference in how Bitcoin has been reacting over the past few months versus the NASDAQ. If we take a look at the NASDAQ with the S&P 500, we've seen a major rebound here. The S&P 500 up over 18.89%, and on top of that, the NASDAQ coming off of the lows at practically, as we'll draw here on our chart, from the lows to the relative highs, up over 24%. Bitcoin, on the other hand, again, being hit more harshly to the downside than the NASDAQ, should likely be rebounding much higher than the NASDAQ. But even though in percentage terms, Bitcoin did come up 42%, this is still minuscule, and you can see it on the logarithmic scale and just by looking at the chart versus the NASDAQ. The recovery here was much stronger, and the sell-off not as harsh. But in the case of Bitcoin, we did not see that, and we quickly saw those gains roll over to a mere 21% return off of the lows. So what does this tell us here? Going back to something we talked about earlier, we talked about the supply and demand economics. It's a very fancy way of saying, are there generally going to be more buyers or more sellers over the next coming months? If there's not a good reason to buy, right? If buyers stay on the sidelines in cash and there's a lot of people willing to sell, well, price is going to go down, and vice versa. If we see a lot of people willing to buy at these levels and most people flushed out of the market, generally known as capitulation, then price is likely having a foundation to move higher. But I don't know, even though we've seen this dramatic sell-off back in June, even though we had a wide range of liquidations, I don't know yet if we've seen our final wave of capitulation. And this employs the topic of the Magic the Gathering online exchange, or Mt. Gox Bitcoin hack. Now, it has taken years for this to finally come into fruition. The eventual recompensation plan, after over 200,000 Bitcoin were recompensated, or at least recovered essentially, from the hack that happened back as far back as 2013 and 2014. Now, when this Bitcoin is finally coming back to the market, we need to understand here that this is not only a large volume of Bitcoin, I think roughly speaking, they're going to be releasing a couple tens of thousands of Bitcoin into the open market, potentially the entire amount. We don't know all the exact details just yet. But the big question here is whether or not those people, when they get their Bitcoin back, the original creditors or owners of those Bitcoin, are they going to be selling it? And while I think everyone will offer different opinions to this, I think the biggest thing that we need to understand is that there are going to be a chunk, whether it be 30%, 50% of those holders who, again, probably had what little life savings they had at the time that are now worth massive amounts of money that they've forcefully had to hold, essentially, through this bankruptcy proceeding and recompensation plan to the original creditors. And now they have the ability to finally liquidate, sell it, and materialize it. I bet a lot of people over these past few years wish they would have been able to sell some of that Bitcoin. Well, a lot of people may argue that, hey, it's great, their Bitcoin, even though they had to be forcibly held, have appreciated a ton of value. Maybe they've learned the value of hodling. And I think that that's a very fair argument to make for some people. The more patient people, the more long-term investors who have a long-term time horizon and don't really need the money, yeah, maybe they will continue to hold it. But I think that you're going to see the majority of this Bitcoin start to unload onto the market, and it will be a race to the finish line. People will want to start liquidating these positions because they know that there are going to be other participants who want to do it as well. This is typical standard capitulation, and I think it's why we've started to see Bitcoin's price already anticipating further downside here, as a lot of sellers came rushing to the order book the other day to drop Bitcoin down another 10% back on August 19th. And along with that, we've also got other things that are starting to weigh on Bitcoin. Not only the fact here that we've got the ETH to BTC ratio getting strength, as there's the excitement around the upcoming merge event for Ethereum, but it's again important to simply dive back into the data science. Through our partner Crypto Quant here, there's a really interesting tool you can analyze for Bitcoin. It is the unspent transaction output, or UTXOs, in profit in percentage terms. And take a look at this, guys. Now, when we generally are in a bull market setting new all-time highs, all UTXOs, 100%, are practically in the green. They are in the profit zone. But during bear markets, when we have drawdowns, we can start to realize on-chain by the Bitcoin when they were last moved as to whether or not they're in profit. Generally speaking, are more market participants entering into profitable territory, which usually happens to a bull market, or we're seeing more and more participants starting to not be in profit, right? Because if you're not in profit with your unspent transaction output, you are at a loss here. Meaning that right now, about 75% of market participants are at a loss. And while that sounds pretty great here in the grand scheme of things, 3/4 of market participants in a bear market, especially as severe as we've seen so far, are still in the green. That's pretty great. At the same time, when we look historically, we've seen that during real capitulation, that we, at a minimum, come down to levels that usually below 50% here, historically speaking. Now, I'm not saying we need to go down 50%. Historically, overall, we generally set in higher lows. But I would say that 75% is probably a very nice ask to have here for an absolute low in the market. And I think that it's very realistic that we're going to be coming down to more conservative and realistic levels of around 55 to 65%. How do I know exactly what that level is going to be? No, no one really knows. But again, this indicator is signaling to us here, as we talked about with the Nupal model, net unrealized profit and loss, some of our other data science models that we watched, that there is likely more downside to go. Another retest of capitulation, similar to that of what we saw back in June. And if you need any further confirmation of that, look at the altcoin market. Altcoin market getting clearly shot down on one of the key lines of previous support that we had pointed out before the correction here. This is where buyers were originally coming in, and now sellers taking advantage of this range when it comes back up into here. And this is typical relief rally activity here, as we've talked about for the past month or so. While we benefited from the relief rally, we recouped some of our losses, we made some short-term trades with equities and crypto here, benefiting from that rebound. We are now starting to see that the pullback is coming back into play, that the bears are still in control here. And if we cannot sustain back above these levels here in the near term, sellers will start to outweigh here. And if Bitcoin is starting to chart it down, altcoins will likely do the same. But it doesn't mean that we have to be bearish in altcoins or crypto as a whole long term. It's just setting our expectations here for the short term. In the long run, I hope that if we get one of these corrections down to 13 to 14K, maybe even something as minuscule as 15K, that would not only be in line with typical standard bear markets for crypto, but along with that would give us a great entry point opportunity for a lot of plays, as we're mainly in cash at the moment, right? So if we keep that in mind, we want to start right now looking for the fundamentally valuable plays in the market in altcoins. And one of the plays that I've been watching, especially as we're stepping into the merge here, I've been looking to try to find altcoins that can actually compete with Ethereum or offer unique value propositions that Ethereum simply doesn't offer. And one of those is Kava. Now, for those of you who haven't heard about the Kava network, they're one of the layer 1 protocols that we're really excited about alongside Radix and a couple other plays that essentially is aiming to offer a really unique value proposition, merging the exciting ecosystems of Ethereum through the Ethereum virtual machine and the Cosmos SDK. Cosmos and Ethereum are two of the most prominent and unique developer ecosystems within the blockchain ecosystem for crypto. And they have a major focus on bringing developers and projects into the Kava ecosystem through the Kava Rise program. And the overall network of protocols on Kava has been growing nearly exponentially here over the past few months since Kava has launched its own layer 1 network, merging these two different types of network ecosystems. And you can not only see that they've had a lot of projects, but they're continuing to funnel this through the Kava Rise program, a $750 million developer incentive program for people who are building and developing in the Kava ecosystem. They're giving away over 200 million Kava tokens to those who are building value and bringing TVL, or total value locked, on to the Kava network. Now, not only is the Kava network rewarding people for building on Kava and deploying projects, but on top of that as well, through the Kava Rise program, they also have the referral program, where people who refer protocols to successfully deploy on Kava can earn up to 10% of all rewards from the Kava Rise program for those projects they refer on board. So this is a really awesome program that is incentivizing a lot of exciting developers who have already previously had experience deploying on the EVM or the Cosmos SDK, or maybe are developing for the first time to come and build value on Kava's network. And I think that this is really exciting here. The Kava Rise is solely focused on bringing not only users and developers to the network, but essentially making sure that the holders of the network are not just investors, but also those who are building value and those who are bringing the developer activity. And along with that as well, just for those who are curious about it, payouts are done from time to time here. 100% of the Kava Rise monthly rewards were just paid out here for August, for June, and July. So again, if you guys are interested in learning more about this, definitely recommend you check the link down below in the description to learn more about Kava and what it has to offer and some of the exciting potential. But I want to go ahead and close off our conversation here. As we go into this topic around Bitcoin, there are a multitude of things that we need to weigh in here. I would say that there are three things that I factor in here. I factor in the price action the crypto is telling us, I factor in the macro environment, and I factor in the micro environment, what's going on within the crypto ecosystem. With the fears around the Mt. Gox release of hundreds of thousands of Bitcoin over the next coming months or years, or even just tens of thousands of Bitcoin from this trustee, we are going to have a lot of potential sell-side pressure and not so much net buy-side pressure. I don't think the market is truly pricing this in. While many people think markets are efficient, let's just go ahead and say that markets tend not to be able to price things in because the majority of buy and sell-side pressure in the market, whether it be miners or short-term buyers and sellers in the market, is something that is not easy to predict and is not under a cohesive thought process. We essentially need to assume that this has not been priced in. And along with that as well, when it comes to the macro environment, with continued rate increases in interest rates, with an inability of central banks to increase their balance sheet or keep it neutral in order to curb inflation in the economy and slow down demand, this is not going to favor risk-on assets like crypto. And if you don't agree with any of the things I just said here, whether or not you think Mt. Gox is an issue, no matter if you think that the macro environment is getting worse, and in fact maybe that it's getting better, just simply take a look at the chart, guys. Now, you all know I'm going to be here. For those of you who have been watching me since 2017, I'm going to be here through the good times and bad. I'm going to cover these markets as much as I can. You guys know that I have no incentive here to try to mislead you guys or try to essentially, just bash crypto for the sake of it. In fact, I'd probably do better being just overtly positive on crypto. Probably get me more views and more subscribers. But I want to be here to talk to you guys about what I'm doing. It's the same thing we do within the Dash report here on the channel, and it's the same I'm going to do here within the channel videos that we publish here on a weekly basis. I love crypto as much as the next person. I think it serves a very valuable proposition of being this asymmetric, non-correlated asset from traditional financial instruments, that it is this kind of autonomous asset that no central bank or government owns, and with its finite supply, it offers the ability for you to hedge your wealth over the long run. But in environments where central banks are making the currencies, in this case, the dollars or the other fiat currencies, much more valuable through rate hikes and the reductions of their balance sheet, dollar liquidity is going to get harder and harder to find, and that is inevitably going to weigh down Bitcoin's price, more likely than not. So I've rambled on enough, guys. If you stayed around for this long, give yourselves a thumbs up and consider dropping a thumbs up on this video. It means a lot. It's one of the great ways you can support this channel. And if you guys are interested in checking out Kava, check out the link down below in the description. You can check out CryptoQuant, our data science partner, and you can also check out the Dash report by getting a 20% discount signing up on an annualized basis. If you like this kind of macro content, I think you guys will also love the Dash report as well. We've got over 1,000, I think 1,000, 1,500 members on the newsletter that are continuing to add value in the community. You guys get to engage with them as well. But that being said, everyone, thank you all so much for watching. And until the next video, I'll see you all in the next one. Take care, everyone.